this is Jim Pearce, Chief Investment Strategist for Personal Finance, with a weekly update on Friday, October 4th, 2024. When the Fed cut interest rates 3 weeks ago, it did so out of concern that the labor market might be weakening. But after this morning's jobs report for September was released, that may not be a problem anymore. Last month, 254,000 net new jobs were added to the U.S. economy, which is far more than the 150,000 figure that Wall Street was expecting. As a result, the unemployment rate fell from 4.2% in August to 4.1% in September. At the same time, wages grew 4.0% over the past 12 months, slightly higher than the 3.9% increase registered in August. That is good news for the economy since rising employment and higher wages equates to more consumer spending. That is especially important as we head into the holiday gift buying season. So here's the report. I have included a link to it in the body of this article, so you may want to take a look at that. Now, not surprisingly, the stock market reacted positively to that news. Small cap stocks, as measured by the Russell 2000, jumped more than 1% this morning. That was more than 3 times the increase in the S&P 500 index and nearly double the gain of the NASDAQ composite. So I'm recording this a little before noon, and you can see up here, S&P is up 0.13% now. Now, the Russell 2000 has backed off a little bit from when I looked at it a few minutes ago. It's now below 1%, but still almost exactly double the 0.43% in the NASDAQ. So here is the Russell 2000 year to date, and you can see it had a nice peak in July, but then it took a sharp drop when people feared a recession was on the way, and it's been recovering. But just over here on the far right, you can see this little spike. Combined with the surprisingly strong 3% increase in gross domestic product during the second quarter, today's employment data confirms the economy is expanding, not contracting. If employers feared that a recession was imminent, they would be laying people off instead of hiring. Today's strong job report is also good news for income investors because the Fed may not feel compelled to cut interest rate as much as it indicated last month. That sentiment is apparent in the bond market as evinced by the rise in the yield in the 10-year Treasury note from 3.6% 3 weeks ago to nearly 4% this morning. So you can see here, a little before noon, it's at 3.956%. We look at the chart and, we'll look, say, year to date. Let's get this going year to date. Here you go. So you can see rates dropping, bottoming out about 3 weeks ago, around 3.6%. But look at this sharp jump over here on the right. So I just zoomed this back down to a month, and you can see right over here, boom. Another bit of good news arrived yesterday when the International Longshoremen's Association called off its strike after reaching a tentative labor agreement with the U.S. Maritime Alliance. That means retailers should be able to fill their shelves with goods that might otherwise be stranded on container ship for weeks or months. With that problem averted for at least the next 90 days, the biggest concern on Wall Street is the potential impact a regional war in the Middle East could have on oil prices. During the past 2 weeks, the price of oil has risen from below $67 a barrel last week to above $74 today. And here we are over the past 3 months. You can see oil prices also bottomed out about three weeks ago. But look here just during the past 2 weeks, and you can see this big incline ever since hostilities in the Middle East really started to intensify. Rising energy prices are a drain on the overall economy since there are far more consumers of energy than there are producers. That is one reason why Wall Street would prefer to see a peaceful resolution to the hostilities in the Middle East. Another reason is the psychological impact wars have on consumer confidence, which in turn influences consumer spending behavior. Of course, the human cost in terms of lives lost is the best reason to avert a war. After all, what good is a strong economy to those who are not able to benefit from it? That is this week's PF Update, and I look forward to talking to you in another week. Thank you.